Welcome to the STR Data Lab.
Hello and welcome to another edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today again with our VP of Marketing, Scott Sage. Scott, welcome to the podcast.
Thanks for having me again. Honored to be here.
I shouldn't welcome you to a podcast that you're co-hosting, should I? So just like, hey,
Look,
Scott, good to see you.
look, you're a nice guy. You're very welcoming. I'll take that greeting from you any day.
Well, it's been, I feel like, an exciting few months. We've been at quite a few conferences. We've had quite a few product releases. Feels like we're rocking and rolling in 2024. What do you want to talk about today?
Man, a lot we could dive into, but maybe a hot topic, and that is rental arbitrage. Not necessarily a new topic, but certainly hot in the streets, as they say.
Yeah, it kind of feels like a 2018, 2017 topic of like all of these companies sort of launching with a rental arbitrage model. And at least all the big companies I was following back then, like the Lyrics, Domios, De Alfred, Front Desk, and all except maybe Sonder are no longer with us. So and maybe a question for you, and I can opine on it too, like, is rental arbitrage dead?
Depends who you ask, where you are, and what your model is. And you're right, it's hot in the streets right now because some of the big names, like you just called out, went down this path at the enterprise level, tried to achieve scale. We're typically talking hundreds, if not thousands of units that they were
Mhm.
trying to rental arb. And unfortunately, we haven't seen that model work. It's hard to get the unit economics right. It's hard to get the right operations in place at that scale. And so, look, kudos to those businesses for growing and trying, achieving scale. And one could argue that factors outside of their control, some macro conditions may have hurt them as well. So, not talking poorly about any of these companies. But if you're an individual host or an individual operator, we're still seeing success in single family homes and multifamily rentals for the smaller scale.
Yeah, I'd suspect that probably many of those companies would still be around, maybe with evolved business models if it wasn't for COVID. Because when you think about the overall, and maybe it's a good point to, like, just talk about what rental arbitrage is, and maybe we can talk about some of the risks associated. And then for all the listeners, we're gonna get to, we had done some research now on what markets, if you're looking to get into rental arbitrage, maybe make the most sense given the data that we were able to analyze. So stay tuned and we're going to walk through those results. But when you think just broadly about the opportunity for rental arbitrage, it's finding homes or apartments that you can take a long term lease on. So I'm going to go, Scott, you own 3 homes, or is it 3 doors? I'm going to rent out one of those homes from you. Let's say I'm going to pay you $2,000 a month, and then I'm going to go try to short term rent it and collect the arbitrage of the difference between what I can rent it on a nightly basis compared to what I have to pay you on a monthly basis for that home. And I think where people get and where some of the risk sort of comes in is I'm guaranteeing you a $2,000 a month check. And if I have a bad month, if I have a bad couple months, all of a sudden I can get myself in trouble because now I don't have enough cash flow coming in on a nightly basis to cover the monthly cost to me to pay you for that property. And if I have maybe 1 or 2 properties, like $2,000 maybe isn't that much, and I can sort of float it or take out a loan or, I've got some reserves coming in. But if I've got 2, 3, 4, 500, 1,000 properties that now aren't cash flowing, you get into the situation that we saw during COVID of all of a sudden travel stopped. The monthly payments for the long-term rents did not, and you just got sort of upside down. So, and there's all sorts of risk, and like cash flow, I think, is one of the big ones of if you're, and when you start to analyze markets, if you're going into a seasonal market, there may be times and months where it's doing great. Like you think of a market like Boston, where tourists come in during the summer and maybe you're able to crush it. But then in January, February, when no one's coming, you've still got that maybe $3,000 a month long-term payment. You maybe only generated $1,000 a month in short-term rents, and you've got to be able to sort of make up that cash flow in some other way, or maybe you've got it in reserves and you were making $8,000 or $10,000 a month during the summer on that same unit.
That's right. I mean, effectively, in this method, your lease payment becomes a debt obligation. And the difference between traditional co hosting or property management in a third party contract standpoint is exactly what you called out. You don't have that debt obligation, and that risk of going underwater isn't there because if rental demand stops, you don't have that lease payment you have to cover. And built on top of that too, you still have operating expenses. If you're a large scale enterprise, you have employee headcount, you have OpEx. And so those two things compounding make it hard to do that at scale. That's not to say it'll never work, just thus far that's been true.
So you talk about in the management contracts, you talk about debt obligations. Just and we all know that you owned a property management company. So when you think about sort of scaling, and then maybe how someone goes about valuing the company that you're building, can you talk a little bit about like how someone would go about maybe valuing those two different revenue streams? Like they're both units that you're managing, and where the sort of values being created and how someone might, like if you're trying to sell that business, value those income streams.
Yeah. So in the traditional third party management scenario, which I have experience in, those revenue streams are valued based on the revenue they're generating, which is tied to the asset, which in this case is a contract. And so you own that contract, you own that relationship with the homeowner or the client in this case. And then you value based on typically it's EBITDA of your operating business. Sometimes there are values attached to the revenue streams generated by those contracts. In this arbitrage example, the problem is there's greater risk with trying to value the income streams for two reasons. Number one, let's say the landlord comes in or whoever your partner is and says they're done with this agreement. This can wipe out a significant portion of your portfolio overnight. And two, the profits. So basically, what we're talking about in this arbitrage, or what we call the STR premium, is less stable than what we're seeing in the traditional third party management. And so the revenue streams are just not as strong when we talk about revenue quality. Typically, when valuing a business, it's much stronger at scale for a third party manager.
That's great. So, and I was asking a buddy, Michael Golden, who's been a guest on the podcast, sort of because he worked at Rented that had a strategy around rental arbitrage, and I asked him sort of the risks in leading up to this podcast, and he called out two things that we haven't necessarily talked about. One is you can't predict supply growth, and when you sort of make that estimate of what short revenues you're going to earn on the short-term basis relative to the long-term rent, there's a lot of risk associated with that future income based on how much competition you have. And in a market growing like we have, and we've seen this more broadly in the sector, that a whole lot more supply growth comes in. It spreads out the sort of demand over more units, and all of a sudden you're just not earning as much as you otherwise thought you could. So you get good at it, and then you tell your friends about it, and they start competing against you, and now everyone's sort of got a problem. And then the other is, and we sort of deal with this all the time with sort of projecting revenues for people. Is there so much difference between the performance of a good operator and a bad operator? And when you look to start scaling your business, it's tough to know what type and what type of income streams you're going to be able to generate, and because there's so much fluctuation there in your ability to really perform at a high level once you start scaling.
That's right. And with that, I think we've done a pretty good job of outlining the challenges of
Yep.
rental arbitrage. The truth, though, is there are a lot of people having success doing this. And so, what do you say we take a look at some of this data and talk about what we're seeing in terms of the STR premiums for arbitrage, kind of year over year, what it's looking like for 2024, maybe how to value and approach this strategy?
Yeah, and maybe just start with like why someone would want to do it. Like, and it's very attractive in terms of getting into the industry as a way to start operating a short-term rental without having to actually go buy properties, right? Or go out and find homeowners for which to manage their property. Because you essentially have the control in yourself. You're like, yeah, you have to find a landlord that's willing to rent you a property. But once you found that, you're able to get going with relatively low startup costs and get it into a cash flow positive, hopefully, situation pretty quickly.
That's right. Typically, your startup costs would be isolated to if there's any sort of down payment or lease fees on the long-term lease, and then design and furnishing, supplies, cleaning supplies, furniture, etc. There are some creative strategies there, or maybe even sometimes you buy a furnished place. So that's right. This is a great strategy for somebody looking to be in the short-term rental game that might not be able to, for a number of reasons, invest and purchase an asset.
Yep. And then really one of the reasons why I was interested in digging into it again is we've seen some massive changes in the multifamily space. So during COVID and in the aftermath of like people moving and sort of expanding number of households, like you were living with friends, now you want your own place, everyone's working from home, like multifamily vacancy rates went from roughly 6% down to like 3%. So like multifamily operators had no real reason to sort of take that risk on a short-term rental operator because like there's just so many people willing and able to rent on a long-term basis. And that pushed overall multifamily rents significantly higher. I saw that was the main driver of CPI growth over the past couple of years. But now we've seen with those high rents that operators able to earn, a lot of supply come in. And actually, last month, we hit a record for multifamily housing completions. So, on an annualized basis, 644,000 new units. And that's a high going back to the 1970s. So, developers are seeing the opportunity to like actually make money again on developing apartments. They started constructing those apartments a couple of years ago, and now they're being delivered. And that's pushing multifamily vacancy rates higher. They're now above 6%, above pre-COVID levels. So, and we're starting to see rents for multifamily buildings actually start to decline. So the sort of investor like in me is like, okay, like there's a glut of apartment units. There may be apartment owners that are looking for creative strategies to get leases on their units, and they may be willing to talk to me again, like maybe they weren't 2 years ago, and sort of do a short-term rental play in their building and allow me to come and operate. Do you think that's like the right way to think about it?
I think it's certainly logical. Think about the economic factors that you're laying out here, it would suggest there's multifamily operators who need to offload some inventory. And if we're seeing that short-term rentals command a premium in those markets, then they may not be situated or positioned to operate those as short-term rentals. Therefore, somebody else can come in this case, a rental arbitrage operator, and capture the spread. And so they can take the rates that the long-term rent operator wants, go operate it in the short-term market, and collect the spread there for a profit. But Jamie, I mean, you're starting to get at this in terms of like property types. So maybe we just also help frame it and contextualize what sort of properties are most favorable for rental arbitrage in 2024 and why?
Yeah. And when we did our analysis, we looked at one, we pulled data from two sources. One from AirDNA. So, what are properties earning as a short term rental? And then we pulled data from Zillow from their rent indices. And they break out the data between single family homes and multifamily homes, essentially apartments. So, for multifamily, we're actually seeing the average premium about 124%. So that's looking, and I'm just going to explain what that premium is. That's looking at the average revenues on a monthly basis that you're going to earn as a short term rental relative to the cost, that monthly lease payment to sort of control that apartment unit. So we're going to more than double the short term, the revenue relative to the cost. Now, there's a lot of caveats like that. On the surface sounds great. Like, I'm going to rent out something for $2,000 and I'm going to earn $4,500 on it. Like, sign me up. Like, but what goes into that too, you've got cleaning costs, you've got the furnishing, you've got maintenance, you've got sort of the time and effort around dealing with the guests, answering questions. There's a lot of time and effort that goes into sort of earning those income streams. But when we look at that 124% compared to single family, that premium's about 104%. So essentially, you're doubling revenue relative to your long-term lease. So on the surface, it seems like multifamily is the better property type for lease arbitrage.
And in some instances, that's even more attractive for a short-term rental operator because if you think about a lot of these multifamily units, oftentimes they have shared amenities. So maybe you get to also advertise a pool or a gym or a parking garage, in which case you wouldn't have in a short-term rental or in a single family short-term rental. And so this can also drive up that short-term rental premium.
Yeah, and I think it also highlights another potential benefit of how to do it well, and there is still some companies actually doing it well. So, I was talking with, Brandy, I'm not allowed to say the old company name, now with Romy, and they essentially only operate full apartment buildings. Because with that, they get, and they still do some arbitrage. They do some sort of management, whole building management. So you do get more into the percent of revenue sort of split in terms of taking on that obligation. But one of the ways they're able to really make it work is because they've got 20, 30, 40, 50, 100 units all in one building. And so now you start to think about the scale of operations that a hotel gets, of instead of having to drive 5, 10 minutes between properties, you're just taking an elevator up and down the floors. You can get a cleaning cart and you can really scale and find efficiencies in a lot of the uh, sort of operations around the business.
The concentration is such a hack for operational efficiency. You think about one cleaner being able to possibly hit, 5 bedrooms if you call it on a bedroom basis, in
Mhm.
1 hour instead of 5 hours. So, that's proven that model has proven to have some success. Alright, well, this is a data lab, Jamie, and it's March Madness season. So, if we're marching towards, let's say, a Final Four, bear with me on the theme
Yeah.
here, and we're looking at possibly the best cities or submarkets for rental arbitrage in 2024. Can you give us a best 4, final 4?
Yeah. I'll do that with a caveat though, because yeah, and you know
Good
how I
job.
love caveats, especially with these sort of best lists, best markets to invest, best rental arbitrage markets. Like, a lot of times there's reasons why they show up with as the best. Because in general, rental arbitrage is legal. And if you have an agreement with that apartment owner to run that unit and lease it out on a short-term basis. Many cities, though, it's not legal. So we did not do a full sort of deep dive into the regulations around each city, but like this first one I know in our final four of Charleston, like in most of the city of Charleston historic area, like you're just not going to be able to do rental arbitrage. Short-term rentals earn really high revenues. Effective rents, like what you're actually going to rent that out or get that lease for, is relatively low. So on the surface, looks like a great market, but your ability to actually go and execute in that market is probably pretty limited.
What I'm hearing you say, Jamie, is do your research. And this is
Do your
a
research.
nice little plug that AirDNA now has that information where you can go see zoning information if a particular instance or market is zoned for STRs or is zoned intentionally not to allow STRs. So there's the plug to do your research, but continue on.
Yep. And then some of these other markets, so rounding out the top four, Providence, Rhode Island, Jacksonville, Florida, Nashville, Tennessee. So Nashville is another market. Rental arbitrage can work, but very specific neighborhoods where you're able to do it, where you're not able to do it. Jacksonville and Providence are interesting because you see different opportunities in different areas of the city. So, and there can sort of be a sweet spot of sort of getting close enough to the ocean where you can start getting that premium in terms of revenue, but being further enough away where it's the apartment building could potentially still have the sort of long-term rents associated with someone looking to live in that market. So finding and that's another maybe half plug for the app of like finding those sweet spots within the submarkets, within the specific zip codes of where are the highest revenue earning ones and like how far do you have to go back off sort of those sweet zones of and generating demand for short-term rentals and still sort of and generate returns.
Well, maybe our final talking point here is just action oriented. And so, how would you explain the formula for success for a successful Airbnb arbitrage business? And then how might you get started or go attack it to execute?
I would start with really trying to understand and or choosing markets that you've got potentially a competitive advantage on, that you know that city, that you know where people want to live and where people want to travel to. Because what's great is if you can essentially find the areas where people don't want to live, i.e., low rents, but people want to travel to, i.e., high revenues. So you sort of have to turn things up on their head of like, that's where the sort of arbitrage opportunity really works out well. So, and it's hard to do if you don't have that sort of deep understanding of a market. And that's maybe where some of the larger operators got a bit out over their skis of trying to expand and go into the markets where they didn't have that deep understanding or weren't able to hire enough people or the right people in those markets. So really, I'd start with the research of the cities that you want to be into and the neighborhoods that would provide the best opportunity to give you a chance for success.
That's right. I mean, I think about a market I used to live in and operate in, of Indianapolis, Indiana. I loved Indianapolis, but objectively, I'm not sure the national average is dying to live in Indianapolis long term. And so the long term rents are lower than the national average, of course. However, it's a big conferences and conventions town, large events town, a lot of sporting events. And because of that, short term rental rates are strong. And so there is this sort of delta between short term rentals and long term rentals that would command a premium for an arbitrage in that market. Now, that's not my endorsement of Indianapolis necessarily, but that's in logic to your recommendation, one way to think about it too.
So I'm assuming if you found that arbitrage opportunity that you're able to scale a significant arbitrage business in Indianapolis.
You had to put me on the spot because the answer is no, I can't follow that up, but not for a lack of trying, Jamie. I swung and missed 20 times, and my approach was I was right when I was starting out trying to talk to individual landlords, single family homes, because I saw that opportunity. Unfortunately, it was still fairly new at the time. They didn't feel confident in what STRs meant and what they brought. Didn't like the idea of having different tenants in their apartment that they owned or house that they owned so frequently, or they asked for too large of a rev share, to be quite honest. And so I think that's just a reality of, hey, you may do all of the work, get all the data right. You may find an investment opportunity that pencils for you. But ultimately, a big piece of this puzzle here is getting your landlord to sign on. And Jamie, as you said earlier, this is legal, but you need to get that approval before you can truly execute.
Yeah. So what do you think's next? You find your market, maybe you find a landlord. Like, what do you then need to do to sort of build this business from scratch? Like, is it just starting your listing on Airbnb or Vrbo? Like, are there different strategies? Like, what do you think's next for someone getting into arbitrage?
All right, so you've been successful. I convinced my landlord, Jamie Lane, to let me rent out his place on Airbnb. The first thing you have to do is exactly what you said at the start. The difference in strong operators versus the average operator is drastic. And the first lever you have is furnishing. So design and furnish in a unique or meaningful or highly attractive manner. The second would be develop that listing that calls out something unique within your unit, within the convenience of wherever the nearby attraction is, get people to book. So that's the first two is really a marketing and advertising play. Classic coming from the marketing guy. But then the third is operational management. So you really have to be prepared, have the right tech stack in place, treat it like a business, not a side hustle or side hobby. Be prepared for maintenance, for bookings, communicating with guests, be responsive, and then treat your guests with the highest service possible. And then last is use a dynamic pricing strategy. I know you've talked about this on prior STR Data Lab podcasts, but just having a dynamic price already puts you above the average operator. And you're leaving significant money on the table if you're not doing this, especially in a rental arb opportunity where you have a fixed payment you have to cover. You can't afford to not have an intentional strategy here. So I think those would be the first 4 action steps I'd be taking to get this off the ground.
That's awesome. Anything else you want to talk about relative to arbitrage, or should we wrap it up?
I think the summary for me is this is still a really strong opportunity to find the rental arb, but it requires the research. It requires doing your homework, digging in, finding those pockets of opportunity, negotiating and talking with the landlords. And if you do your homework and you evaluate this properly, you have an opportunity to make a killing.
Awesome. Well, Scott, on that positive note, we'll wrap it up. Thanks everyone for sort of tuning in to this edition of the STR Data. We'll see you next week.
Thanks, everybody.